What's going on, everybody? Welcome to a Capital Hungry Market Update and Trade Ideas webinar. We'll be going through some individual market analysis to break down what's going on with the US dollar fundamentally and technically, gold, GBPJPY, US dollar pairs such as GBPUSD, EURUSD, and USDCAD, US 30 stock market index, and looking at what economic events we have, fundamental impacting factors, market sentiment, a volume reading, and of course, what everybody looks forward to, the trade ideas and trade setups across these trading instruments. So if you've been following along Capital Hungry Market Updates, any of the live streams, any of the higher time frame analysis, you would understand that the fundamental macro information advantage and what the market has been pricing in from a macro fundamental perspective is the Fed monetary policy when looking at the US dollar. Stopping stimulus, raising rates, tapering, which is stopping stimulus and stuff and so forth, and reversing all of the actions they took when they were pumping the markets. This is the reason for the last year, as they started to give signals of tapering, signals of rate hikes to come, signals of more aggressive rate hike plans, and the actual action of rate hikes. This is the reason why US dollar has been so bullish from a macro higher time frame perspective. The Federal Reserve monetary policy positioning and what the central bank does alongside government policies is going to hold the most weight in terms of impact to a currency or a country's stock market. And in this example, talking about the Fed, USA, and US equities, and of course the US dollar, they are the cartel of the currency. What they do is going to hold the most weight. We have seen that when we have short-term bad US economic data, we can see some short-term downside. But the main reason why dollar has been so bullish, why the stock market has been so bearish, why gold and other asset classes and commodities such as the real estate market have been so bearish, even why crypto has been so bearish, is because of the Federal Reserve stopping stimulus, combating inflation, actively raising interest rates. The same time, the majority of these asset classes hit extremely high price points when you're looking at the real estate market, gold, commodities, crypto over the last 2-year run, when inflation was already extremely high and continuing to rise, which it still is, but that has already all been priced in and adjusted. So over the last couple of months, this excessive upside on the dollar here from a more intraday perspective has been the market pricing in 75 basis point expectations and even 100 basis point expectation increases in interest rates for the July FOMC meeting to still come. So what we have seen is the reason for this excessive excessive upside on the US dollar and the correlated downside on gold, downside on GBPUSD, EURUSD, and the US stock market has been because the market has been pricing in this fundamental information. The institutional algorithms adjust to this real world fundamental information where the cartel of the currency dictates the market waves and market flows and how the institutions down the line will adjust accordingly. So before the July FOMC has even happened, the market has already begun to price in a very high probability of a 75 basis point rate hike and even 100 basis point rate hike, which was expected after the very last high CPI reading. The last high CPI reading just signaled to stock market investors, to the market makers, to the whales, that the Feds are going to have to aggressively continue to raise interest rates to combat that inflation before inflation enters very high risk hyperinflation levels, which can destroy an economy in itself. So this is your classic playbook of Wall Street market psychology of buy the rumor, sell the news. We've already had this excessive upside on the dollar due to these rumors of the rate hike probabilities and the market adjusting to it accordingly before the July FOMC has already happened. And of course, on the higher time frame, we've been in an extremely bullish bias on the dollar ever since the tapering rumors started in 2021, right? And what we can see is it's very common in terms of market behavior and psychology that once a lot of the higher time frame macro fundamentals have been priced in, it is very common at new intraday and higher time frame highs that are printed that you can enter short-term secondary phases of the market. Secondary phases of the market being either pullbacks with buyers liquidating positions and sellers jumping in to provide that exit liquidity as a lot of the information advantage has been priced in, or consolidation zones where you have periods of indecision and accumulations of order flow before continuing majority with the higher time frame trend. And when you understand these phases, you can also understand that the majority of pullbacks are also usually in relation to the upside impulsive moves you have, continuing the price of this asset class higher as we've been pricing in that Fed monetary policy positioning. So what I'm trying to say is we've been playing excessive upside on the dollar, but at the current moment on the intraday timeframes, we can start to see exhaustion at the 108 price handle. If we stay below 108, it would not be out of the ordinary at all to start to see short-term pullback phases and short-term downside on the dollar, potentially going to retest previous highs as a demand zone before collecting enough buy-side liquidity to continue higher, right? So a lot of the fundamentals of the 75 basis point rate hike expectations, of even the 100 basis point rate hike option being on the table for the July FOMC meeting, a lot of the economic data we've seen, that information has been priced in, especially ever since the June FOMC and the rally we have had since. And when you're coming to look at the price action, you can see we're starting to get this technical double top, which the double top signals to me not enough buy-side liquidity to continue higher, buyers exiting positions and sellers potentially jumping in hand to provide that exit liquidity, where if we continue to respect some of this pullback structure from these intraday highs, it would not be out of the ordinary for us to see deeper pullback phases before continuing further bullish in terms of understanding market behavior, market psychology, and how to stay adaptive to the waves that are very common and occur. Because at the end of the day, even though we've been in a higher time frame bullish bias on the dollar, as a day trader, as a scalper, even as a swing trader, whether you're holding trades for days to weeks, you don't want to marry a bias. You still want to stay adaptive to the market waves, which happen very frequently and cannot be ignored, right? So let me give you an example. The main reason why dollar has been so bullish is, of course, the Federal Reserve monetary policy. This is the hawkish tone and the increase in interest rates that has kept the stock market extremely bearish after peaking all-time highs at around 36.7 here. And the reason why stock market has been devaluing over that period of time is buyers liquidating positions, because the reasons to jump into the stock market and continue to invest are no longer favorable. You have extremely high prices. You have the central bank stopping stimulus and stopping pumping of the markets. You have the central bank also raising interest rates, decreasing the likelihood of institutional lending and spending and investing back into the markets. So you have less favorable conditions for the US stock market to be bullish based on that fundamental correlation to the central bank policy positioning and decisions, which they've been actively raising rates. The correlation between these trading instruments is between the central bank actions. As we're seeing more demand in the dollar for interest rates going up and the stopping of stimulus, potentially combating inflation, those are the same fundamental reasons why stock market has been bearish. And those are the same fundamental reasons why gold has been so extremely bearish, going all the way to those monthly demand zone lows that I've been telling you guys about for months and months and months, giving us the same exact historical repetition we saw after the 2008 GFC, when the 2013 taper tantrum started to occur, and of course, when we started to raise rates in 2014, 2015, and so forth, right? So that's the fundamental reasoning why. And that's why gold has been so bearish, stock market has been so bearish. Pairs like GBPUSD and EURUSD have been so extremely bearish against the US dollar, because the US dollar is your world reserve currency and global business currency. But as a lot of those fundamentals have been priced in, as we don't have too much more US economic data at the moment or reactive fundamentals in terms of geopolitical tensions that haven't already been priced in, as we're watching dollar movement, unless we're trading back above 108.5 on the dollar, this would signal that dollar demand is still extremely heavy and the market is still pricing in more rate hikes to come. Right? And adjusting to that accordingly. This correlation of dollar seeing buyers back in play on the higher time frame, trading above 108.5, would also lead to a market sentiment play and intermarket correlation of US 30 stock market index trading below 30K flat, gold trading below 1698 and 1700s flat, GBPUSD trading back below 1.18 flat, and EURUSD trading below 1.10 parity point between euro and US dollar. Otherwise, if we don't see dollar trading back above that key price point of interest on the higher time frame, what is potentially very high probability is we can see deeper pullback phases on the dollar occur, where if we see the dollar enter that secondary market phase of pullback and correction, what we're going to see take place on the higher time frame on our dollar pairs is very, very common, and starting to see some type of liquidation of sellers and buyers jumping back into the market, right? So if we see that short-term dollar weakness in play, GBPUSD trading back above 1.2, we can easily see deeper pullback phases on the higher time frame, which is extremely, extremely, extremely common. Sometimes these pullback phases can extend for weeks, even months, before seeing continued downside. And on EURUSD, you see something very similar. And on gold, you'd see that fundamental correlation where gold can potentially be trading, if it really comes back above the 1740s, can easily see a pullback to previous lows and sell side liquidity zone in the 1800s. And when you understand gold movement, you can see even as gold has been making its way to the downside, it is very, very common to see aggressive pullback plays or correction phases of either consolidations or aggressive pullbacks that can occur to retest better sell side liquidity zones before still continuing overall bearish on the higher time frames. So understanding that about market waves and phases, we are at a point where coming close to the July FOMC, where we have a lot of the market fundamentals priced into this point, where we're at very key indecision areas where we could either have continuations with the higher time frame trend if we break these specific lows and just continue down. In the example of gold, GBPUSD breaking its lows, EURUSD, and dollar trading back above 107.7, 107.8. But we have to stay more adaptive than ever before, because it's very common to see these corrective phases, right? Now, bringing that information together, if I can see dollar trading below 107 price sensitivity area here, right? Signaling that a lot of the current fundamentals have been priced in, dollar in a short-term pullback in corrective phase, potentially retesting 105.5. The expectations and correlated move would be that GBPUSD would be coming back above its previous intraday lows and price sensitivity area in giving pullback corrective buys above 1.2 flat, potentially coming to these sell side liquidity zones before continuing bearish on the higher time frames again. That correlation of dollar trading below 107 flat on EURUSD would see us trading above this price point of interest at 1.02 flat, at least going to retest previous lows and sell side liquidity zones, having short-term pullback structure before seeing sellers jump back into the market again. This would also correlate to gold trading above 1740s and having deeper pullbacks to 1800s before possibly continuing bearish again. Now, something else we have to understand in terms of market waves and understanding corrective phases versus impulse phases with the higher time frame trend. For example, when we're looking at GBPUSD, you can see the corrective phases in pullback structure that occurs when you're potentially ranging or having pullbacks is always a lot slower and far more messier in terms of its intraday price action as you're edging back up to potential better retest sell side liquidity zones, whether it's a corrective phase of consolidation or a corrective phase of pullback. But as soon as you're entering back into your higher time frame bias, the impulsive moves that go to print significant lower lows are always very fast and very impulsive, as stated. So what I'm trying to say is, if we start to see corrective phases occur from these very specific intraday lows, what we have to stay adaptive to in terms of trading psychology and market structure is, yes, we can have that potential short-term upside on GU, but don't expect it to be so smooth and steady compared to your moves with the actual higher time frame bias. And the same ideology goes with the gold. The same ideology goes with EURUSD and USDCAD and the US stock market index as well. So some key takeaway points at the moment. Yes, dollar is higher time frame bullish. GBPUSD is higher time frame bearish. EURUSD is higher time frame bearish. Gold is higher time frame bearish. But we do have to be mindful as we're coming closer to the July FOMC with a lot of that information priced in, as we're starting to see some exhaustion on dollar as your world reserve currency. If we see dollar trading below 107, GBPUSD trading above 1.2, EURUSD trading above 1.202, US 30 trading above 31,500, gold trading above 1730s, it's going to be very, very high probability that we're seeing corrective phases and pullbacks on these pairs against their higher time frame trend before continuing back up with the higher time frame trend, right? Otherwise, for us to jump back into the main bias, we would need to see dollar trading back above 108, EURUSD breaking its current lows, GBPUSD breaking its current lows, and gold trading below 1700s, as well as US 30 trading below 30,000 flat. Okay, and we'll talk about GJ individually in a minute. It's just very important to understand Fed monetary policy, impact on dollar, impact on these other trading instruments. But now, before we jump into the more detailed analysis of correlations and understanding these market phases, we just want to understand what economic events we have on the table. Overnight at pre-London hours, 2 a.m. Eastern, we have some labor market data for the UK with expected weaker unemployment rate and an increase in unemployment rate and job change being relatively weaker as well. This can keep less demand in the British pound in the short term. We also have some inflation figures for Eurozone overall at 5 a.m. Eastern, and then at 8:30 a.m. Eastern, some relatively minor US economic data just with building permits and housing starts. In terms of political information and political speeches going on, we do have Janet Yellen, sorry, in South Korea. So you might see some headlines from her, and we do have some Fed speakers later in the afternoon. But other than that, relatively quiet. Now, when we're looking at gold, we're coming to very, very key higher time frame demand zones, but can easily still dig into the 1680s, especially if we're trading below 1700 and just see dollar buyers back in the scene, stock market relatively bearish, and using those correlations of fundamentals to our advantage. So when I'm coming to look at gold here, if we are trading below 1700s in 1698, then just continue our higher time frame bias, which the correlation confirms would be gold bearish price action, of course, and breaking its lows, signaling more lows to be printed by sellers. Dollar bullish above 108. Stock market bears still showing that Fed sentiment is holding most weight. Okay. Otherwise, if we fail to break these current lows and we see gold buyers back above 1721 and potentially even 1730, I can see short-term pullback corrective buy phases to potentially better sell side liquidity zone here at around 1745s and 1747. The correlation for this and the trade ideas to play accordingly for the short-term buys would be gold failing to break lows, current lows at 1700s, dollar bearish below 107, just shows us that the Fed sentiment is starting to get faded out. Stock market buyers saving face. Break above 1721. Otherwise, whenever gold is in a potential corrective phase, for the example here, when we were having a consolidation rather than any chances of pullbacks above the rejection points, this area from roughly around 1713 to 1704 is a heavy indecision area where the same time we have lower volume and volatility and we're waiting for more fundamental catalysts to come to the table, and at the same time we have some short-term weakness in the dollar, you can have a lot of indecision messing up your account in this area if you're trying to scalp with the aggressive price action or even intraday trade. So this would primarily be a no trade zone. Now, this type of ideology of the fundamental and technical confirms of in terms of market structure, price action, and the fundamental cues is the exact same on our dollar pairs such as GBPUSD and EURUSD, because the primary driving factor of those pairs being so bearish is the Fed hawkish sentiment and tone, and of course that correlation with dollar being your world reserve currency. So you're going to see very, very similar type of ideology when we're narrowing down trade ideas here on GBPUSD. If we just have clean break and retest back below 1.19, back below 1.8 key level, I would just be looking for continuation sells, especially here with, again, dollar above 108, weak UK labor market data, break below key levels. Otherwise, if we start to trade back above 1.2 after a short-term pullback for the new daily candle, trading back above previous intraday lows, and if we're trading above 1.21, I can easily see some short-term pullback phases before potentially retesting better sell side liquidity zones. And again, the correlation would be dollar bears, neutral UK data, break above key level and previous lows to the left here. Now, the reason why we're marking out these scenarios, the reason why we're creating these trade price points of interest with both fundamental confirms, correlation confirms, and price action and structural confirms is because in a fundamental perspective in terms of market timing, we're coming to an indecision point. And we're also at an indecision point where we could either have continuations with the main higher time frame trend or short-term pullbacks based on price action and market structure as well, and understanding the behavior of these trading instruments and the transactions that occur between buyers and sellers from an institutional perspective. So what we have to be very, very focused in on is how adaptive we stay and how patient we are waiting for these trade ideas when we can see that the conditions may be messier in terms of intraday price action due to the current fundamentals being priced in, July FOMC information being priced in, slowdown in volume and volatility. And we have a lot more important stuff later in the week, such as ECB rate decision, Bank of Japan rate decision, and other important economic data such as PMI figures. Euro USD. If we just start to trade below 1.0 flat, 0.995 key level, we have continued US dollar strength and dollar back above 108, weak euro economic data. We have a priced in ECB sentiment when ECB rates come later in the week that I can see just continued downside. Otherwise, with ECB statements, it is very, very common that when they bring some hawkish remarks to the table, you see euro strengthen with, of course, rumors of rate hikes and coming out of negative rate territory and stopping their stimulus and so forth. Whenever you back test this on Euro USD, this is always a short-term upside liquidity grab, even though the price action may look very impulsive where you see like a bullish engulfing candle, but 9 times out of 10, it's extremely, extremely short-lived. And let me give you some examples. Just off the top of my head, I remember this being one of those examples in here as well, where you had short-term upside stimulated by a hawkish ECB sentiment, but only going to revisit better sell side liquidity zones as dollar domination takes over as your world reserve currency. So when we're bringing that information to the table here, I would see safer continued sells below 1.0 parity point in 0.995, exactly where these last lows were printed. But other than that, it would not be out of the ordinary at all that if dollar is turning bearish in the short term, a lot of the Fed sentiment's been priced in, we get a more hawkish move from ECB later in the week, that we can have these aggressive bullish pullback plays and stay adaptive to that pullback before potentially retesting better sell zones on the higher time frame. With the same fundamental correlation factors as stated on gold and on GBPUSD. So we have to stay very adaptive, lower volume and volatility, starting to see exhaustion and pricing in of the main fundamental catalysts, starting to see potential corrective phases enter the market, that we have to stay adaptive to those market waves and not get caught in them on the wrong side. Like meaning, even though Euro USD is extremely bearish, if we start to see a very common pullback phase occur, you don't want to be selling Euro USD and it does like a 200 pip pullback to 1.04 before continuing back down again. You know what I mean? Now, USDCAD. When you're looking at USDCAD, especially in this overall structure, as you have these significant highs printed by buyers, you also have these very, very significant, messy corrective bearish pullback phases that occur, as overall USDCAD is still edging to the upside in terms of its price movement over the higher time frame. But the Canadian dollar has had some strength with, of course, the Bank of Canada being more hawkish and actively raising rates, even doing a surprise full 100 basis point rate hike. And Canadian dollar has had more strength in terms of its correlation to crude oil for smart money market makers and investors, where they correlate the strength in crude oil and higher price of crude oil per barrel, meaning more revenue for Canada, as that's one of its main revenue sources. So in my opinion, if USD CAD is staying below these previous intraday highs, yes, it can get potentially messy in these areas, but there's a higher probability that if dollar also has a pullback below 107, a short-term pullback phase, and oil still holding some strength, that we can easily see deeper corrective phases on USD CAD. Bringing that information together, I would see sells below 1.29, sells below 1.283, sells below 1.277, medium-term zone and key levels here. Otherwise, I'd only be jumping back in higher time frame buys above 1.316 with validation dollar buyers are back into the scene, validation crude oil relatively softer, and Canadian dollar individually holding a bit more strength if you're looking at other Canadian dollar pairs or individual Canadian dollar currency. Now, US 30 is overall in this indecision point at these higher time frame lows, where you can see it is very common based on market psychology to see bear market rallies occur. This is stock market buyers grabbing up dips, saving as much face as possible, also trapping in a lot of buy side and retail liquidity, where then they liquidate positions from better sell price points of interest. You can see as sellers print these significant lower lows, if you don't break those lows and also correlated if you backtest, have short-term weakness and less demand in the dollar, you can have very aggressive dead cat bounces and bear market rallies to better price points of interest before continuing back down bearish again. Now, the situation we're looking at here is more similar to this situation, where you had multiple retests of lows fail to break, a bit of a technical double bottom being created in this area, showing more exhaustion by your buyers, breaking above previous significant lows, then seeing that upside play retest better sell zones before continuing bearish again, right? Here you can see a similar situation where a lot of exhaustion around 30K flat, retesting these previous lows, where if we're actively trading back above 31,500, we see that dollar is short-term bearish. Very, very common to see that pullback phase, short-term bear market rally and dead cat bounce before continuing bearish again. With that information together here, I'd be looking for any pullback buys above 31,500 and 31,700. This area would be a no trade zone for me, and I'd only see safer sells below 3,300 and 30K, or of course, if we come to these better sell side liquidity zones and have a pullback first before continuing overall bearish. Remember, staying adaptive to current market conditions. Volatility index is still relatively flat. Dollar short term is seeing less demand, but I would need to be trading above 31,500 to see any potential revisitation of the sell side liquidity zone to the left. Last but not least, GJ. GJ on the higher time frames has been extremely bullish, as the Japanese yen is individually bearish due to the very loose monetary policy of the Bank of Japan, keeping interest rates still in the negative, still keeping an unlimited bond buying program and stimulus going. And obviously the central bank action as the cartel of the currency is going to hold the most weight in terms of the market impact from a fundamental perspective. At the same time, you also have the Bank of England actively raising interest rates. Yes, price action has gotten a little bit messier, but we can't ignore the higher time frame bias here, where we're still very bullish above previous highs. We still have these higher time frame highs to revisit. We're starting to break above some of that corrective structure, and we've generated a lot of buy side liquidity from 162. Yes, we might get some short-term pullback phases, especially with the Bank of Japan rate decision later in the week, which could lead to a short-term downside move. But overall, I'm still expecting us to chug to the upside to 168, and would only see higher time frame sells below 162. Bringing that information together with the intraday analysis, one thing we have to be mindful of is, of course, the labor market data, which is expected to be a bit weaker. we can see buyers consecutively printing intraday higher highs, but what is also very common with the lower volume and volatility is very aggressive pullback phases that can occur as well. When I'm looking at GJ here, if we trade back below the previous intraday highs, it would not be out of the ordinary for short-term sell plays on the intraday and as scalps to retest better buy zones before continuing overall bullish again. Meaning below 165 flat here, I would see short-term sells and below 164.8, watching buy zones at liquidity zone 164.2 or 163.8 retest of structure. Otherwise, I need to be trading back above 165.5 and back above these intraday highs to be taking continued buys on GJ. So short-term sells, if we break back below the previous high, just showing us buyers exiting positions, entering a pullback phase, which is very common on GJ, especially with how it's been behaving since the very start of the month, would just be, in my opinion, setting up better buys from better positions, or just continued buys back into this bias on the higher time frame. Right? So this was a bit of an educational webinar, understanding why dollar has been so bullish, the correlation it of course has, and the potential exhaustion we're seeing with a lot of the fundamentals being priced in. We have to be way more adaptive, way more patient in the current economic and market conditions. We have to continue to watch these fundamental catalysts occur. And those are the trade ideas and analysis across the board there, understanding the current market waves, the current market phases, what's going on fundamentally, and what we're still waiting for on the table there.